All right, let's jump right in. We're going to unpack the turmoil that's shaking up the financial world. You've probably seen it. Stocks, crypto, it feels like everything is in the red. So, what's really going on here? Why is it happening now? And what could be coming next? Let's break it all down.
First, let's start with a number that just tells you so much of the story. $500 million. That's how much cash fled from crypto funds in just a single week. But get this, one single asset manager was responsible for almost all of it. That is a massive red flag about institutional confidence right now.
And that brings us to the core question that I think is on everybody's mind. Wasn't crypto supposed to be the hedge? The safe haven when traditional markets got shaky? So what on earth is going on? Why are they both falling together? The answer, well, it's not as simple as you might think. To really get what's happening today, we've got to look at a relationship, a partnership really, that has completely broken down. A key correlation that used to basically define how markets moved has just snapped.
You see, for the longest time, Bitcoin and the tech-heavy NASDAQ 100 moved like perfect dance partners. Tech stocks go up, Bitcoin follows along. Tech stocks go down, Bitcoin does too. But that dance is officially over. They have totally decoupled, and Bitcoin's fall is proving to be way, way steeper.
Analysts have this powerful and honestly pretty intense name for this pattern. They call it the jaws of death. And it's because when two assets that used to move in sync suddenly split apart like this, the gap on the chart literally looks like a pair of open jaws. For traders, that is a huge warning sign. So what caused this sudden dramatic split? Well, the trigger is actually pretty counterintuitive, and it all starts with this political paradox over in the US. This is one of those classic cases where the market did the exact opposite of what anyone expected. This is truly a head-scratcher. Back in early October, the US government shuts down, and what happens? You'd expect panic, right? Nope. Bitcoin soars to a new all-time high. But now the shutdown's over, things are supposed to be getting back to normal, and now the markets are plunging? The sentiment has been described by traders as, and I'm quoting here, disgusting. Okay, this is a huge piece of the puzzle right here. The Federal Reserve. Just a few weeks ago, the market was 98% certain we'd get a rate cut in December. I mean, that's practically a done deal. Fast forward to today, those odds had been slashed to just 44%. That kind of drastic reversal in expectations sends shockwaves through the entire system. And of course, none of this is happening in a vacuum. The market is also trying to digest this whole cocktail of other pressures. You've got rising geopolitical tensions, this lingering uncertainty around US trade tariffs, and this ongoing debate in Washington about weakening the dollar. It's just layer upon layer of risk that investors are now trying to price in. So how are the pros on Wall Street reading all these chaotic signals? They're looking at the same data we are, but their diagnosis gives us some really fascinating insights into what's going on under the surface. Analysts over at Goldman Sachs basically highlighted just how wild of a ride it was. They pointed out that despite these massive swings during the day, moments of real panic, the big indexes like the NASDAQ and S&P 500 actually clawed their way back to end the day almost flat. It's a sign of a really fierce battle raging between buyers and sellers. So how did the market pull off that rebound? Well, Goldman pointed to a few key things. First, stocks hit these really important technical price levels. You can think of them like floors, where buyers just automatically stepped in. Second, a huge chunk of the buying, 37% of the total volume, was driven by automated ETF flows. And finally, those big tech stocks, the Magnificent Seven, they managed to bounce back and finish the week without losses. All of this daily chaos just leads to the biggest question of all. Where do we go from here? And to figure that out, we kind of need to zoom out and look at the bigger picture. So if we take a quick snapshot across other major assets, it's a very mixed bag. US bonds had an extremely volatile week. Gold, interestingly, actually managed to climb 2%, holding onto some key support levels. Oil was surprisingly stable, and the US dollar, it just held its ground. So it's not a picture of uniform panic, but it's definitely one of deep uncertainty and a lot of repositioning. In times like these, the market is always looking for a guidepost, some piece of solid information to cling to. And the next big one is right around the corner. All eyes are now turning to November 20th for the release of the US jobs report. This one piece of data could either calm a lot of nerves or, trigger the next major wave of volatility. And that leaves us with this final, really thought-provoking question. While we're seeing retail investors and ETFs buying the dip, there's another group we have to watch: corporate insiders. And the data shows they have been aggressively selling shares of their own companies for the past 2 months. So the question is, who's right? Is this just a temporary little correction, or are the insiders trying to tell us that this is the start of something much, much bigger?